Phil Streible, Chief Market Strategist at Blue Line Futures, is back with us to discuss market volatility and what's next for traders and investors alike. Phil, welcome back to the show. Always good to see you.
Thanks for having me on.
Let's talk about what happened over the last month. Well, over the last week, the S&P 500 had a slight rebound, but if you zoom out and just take a look at what happened in September, the markets got hammered. Now, the volatility that we've seen over the last September, one might say it was seasonal, but I want to get your take on what exactly caused this massive drop-off in pretty much all assets, not just stocks.
Well, if you look at the current economic environment we are in a deflationary environment that's forecasted to go out for 3 more quarters out. So it does carry the highest degree of volatility, and it should be in a declining market fashion. So all equities starting to head lower. And you've got the Federal Reserve coming out, they're tightening into it. Other central banks are tightening as well. So when you tighten into an economic slowdown, you tend to get this vortex that pulls everything lower.
Okay. You said deflationary environment. The CPI print's still pretty strong. Can you explain what you mean by that?
We're coming down. The inflation's coming down. You could already see it in food prices. Now, OPEC did mess with the current administration and the Federal Reserve by cutting 2 million barrels per day on crude oil inventories. So you are going to see elevated energy prices again. But you could see there was just a data point that came out that, apartment demand is at its lowest level in 30 years. There are deflationary environments, and you are going to see things continue to come down. I mean, look at the price of gold, silver, they're down significantly. All your meats, your energies, they're all well off their high. Crude oil was at $120. It's only at $88 right now. These are deflationary environments that we're in.
Okay. Now, do you think that the Federal Reserve then needs to step in further and fight this inflation? If you're talking about all these other factors that are contributing to this deflationary environment, well, then in theory, Phil, the Fed doesn't need to do anything, right?
The problem with the Fed is they look in the rearview mirror. So in the previous months, yes, inflation was higher, but it has been gradually coming down. And that is the problem, is that they're going to over tighten because they constantly look at data that already previously happened. So it's going to take them tightening farther than they should be in order for them to realize their policy mistake. By then, equity should be lower. Like, we should see the S&P 500 closer to 32 to 3,300 by the time they realize the policy mistake at hand.
Are you suggesting we've got another 500 points of downside to go for the S&P?
The S&P, oh yeah. Yeah, I'm pretty confident on that. By year end, we should see another interest rate hike. Over the November 2nd meeting, that's going to be another dagger. We're also going to go into a corporate profit recession. Look at all these companies right now. They're scrambling. They're laying off workers. They're instituting hiring freezes while the wages are at elevated levels. So it's squeezing all their profit margins. All this is going to come out. It's going to take a couple of quarters for it to, completely expose itself. But trading equities to the short side is the way to go.
Okay. Now, just on the point about the Fed, and we'll move on to other subjects, the CME Fed Watch tool is pricing in an overwhelming probability of at least 50 to 75 basis points. I don't see 100 basis points in the cards or on the table just yet, but what's your take? 75 basis points, 50?
Well, the defining moment, I think, comes tomorrow when we have the jobs number. If that jobs number comes out anything north of 315,000, or that unemployment rate ticks down below 5.4%, you're going to see the more hawkish narrative come out. The 75 basis points will most likely be the probable outcome. You'll see equities and you'll see all commodities. They're not going to like that at all. It's going to sell off on that type of news, and a dollar index and yield should ramp to new highs.
Okay. I want to talk about your outlook for the equity markets over the medium term. Recall that in 2020, we had a sharp retracement to the downside and then another sharp rebound to the upside, a V-shaped recovery for the equity markets in 2020 and during the pandemic. Of course, back then we had stimulus, Fed stimulus. Things are a little bit different now, but what do you see happening? I mean, we've had a long sort of decline. We had this slow grudge to the downside ever since last December. Some might argue, hey, it's time for a rebound. What do you think?
So the way you get the rebound, and if you just rewind to previously during this week, you had a couple different things come out. You had the PMI data; it was softer than expected. They were expecting like 52.9. We come out at 50.9, something like that. So you get weaker economic data that charges the rally because people are trying to play into the narrative that the Fed is going to pivot early. You get the Bank of Australia, they came out and they only raised rates 25 basis points instead of 50. And you get that second confirmation that there's some dovishness coming out by central banks. Bank of England last week trying to buy the long end of the curve. These are all dovish pivots. The problem is that they can't be dovish right now. They're just going to drive up the very thing that they're currently fighting. So I think any significant rally that you get on equities, you need to trade that to the downside. You can have stop losses. You can use put options. You could write call options against your current equity positions. There's a number of things you could do to get defensive in this environment.
Okay. Now, could you foresee some sectors within the S&P 500 that will outperform other sectors, perhaps even do well and gain over the next few months?
Typically you would see like utilities and energies, those should do well. Your consumer staples, those should do well. Those are things that people are naturally buying, more defensive in nature. But, your consumer discretionary, that's the one you want to be short. You want to short things that people don't need or things that already people have. You look at anything else. How many TVs are you buying? How many grills are you buying? How many, what are you upgrading in your house? Not really much of anything. Their savings rates are at near record lows right now. Their credit card debt is at a record high, and that borrowing cost is at a record high. So I think any of your, I'm not rushing out buying the next iPhone or a new iWatch or anything like that. Just not happening.
So what is the American culture when it comes to savings? Let's just discuss more philosophically. If you have a lot of money right now, Phil, I'm not saying you don't, but let's suppose we don't have inflation. Let's suppose we don't have Fed tightening. Let's suppose you get a windfall of $20,000 in this current environment, Phil. Would you save that 20 grand? Where would you spend it?
No, cash is king right now. And look, you're going to get a savings rate on that money. We're going back into positive yields. So there's no reason to go out and spend that money at all. I surely wouldn't be chasing profitless tech companies out there. I wouldn't be trying to, be a hero and buy the NASDAQ, the S&P, or the Russell for that instance.
Okay. That's interesting. Now, in 2008, we saw Walmart gain, I think, something like double digits over the course of the bottom to 2009 when things started to recover. What's going to happen this time, do you think?
So that's a safe haven play. Look, you stop shopping at Whole Foods. You go back to your discount, grocer. You stop going out and buying unnecessary thing, and you get back down to the staples. That's why Walmart does well in that type of environment. Those are safe haven type plays. That's where you want to be. Just take it down, strip it down to the building blocks, and you buy those specific things.
What about e-commerce retailers like Amazon?
Oh, I see. The thing is if you look at Amazon, they're just doing a hiring freeze right now. They've got a number of their own problems that are going on. I'm not a big believer in Amazon at the moment. I think that you need to be shorting Amazon on any kind of rallies. You short all that basket. You short Apple, Amazon, Tesla, Google, Netflix, you name it, you short it on any kind of significant rally. And if you don't want to short it, just buy a put option on it.
Looking ahead now, and I'm talking about way ahead, what signs would you be looking out for the end of the recession? In other words, hey, spring is here. It's time to get back into buying mode.
Okay, you wait. So I saw a back-tested presentation. It was put out by 42 Macro yesterday, and they put out a slide that goes on when the bottom of equities generally happens, and where it occurs is usually 1 month at a minimum from when the Fed pivots. They outlined 3 or 4 different scenarios from 3 to 5 months out, but it seemed like when the Fed stops, whatever the pivot is, whether it is when they stop raising rates or when they finally have over tightened and they cut rates, then what you do is you go about 1 month out. Historically, that's when things start to bottom. It takes a few months for growth stocks to bottom as well.
Interesting. All right, let's talk about some of the commodities now. Let's start with gold. Now, gold has had a pretty rough year, to say the least. 1,700 is kind of the support level that we've seen being tested a few times over the last 2 weeks. What's next for gold, Phil?
I think that gold's going to head lower. If you continue to see that dollar strength, it's going to be a headwind on gold. Same thing with your you get rising yields coming out. That's going to be a headwind for gold as well. Gold had a nice bounce off of the low end of the range. We shot up over $100. It failed at the 50-day moving average. I'm not a moving average guy, but it did act as some psychological resistance. I'm surprised that gold's holding up right now. There is an implied volatility discount, so there's some complacency in markets like gold and silver at the moment. I think that leaves themselves susceptible to another correction. You don't get these massive moves up in things like gold and silver and copper and not see the ramifications of a few days, later once, that fairy dust tends to disappear.
So you see more downside, or at least headwinds stay in place for gold. What about this, Phil? Just to play devil's advocate, do you see any scenario in which the dollar, the U.S. dollar, could be significantly pushed down such that gold would be boosted?
Okay, so when you saw the dollar correct the last few days, you saw immediately investors charged into foreign currencies, the metals, and the stock indices. And it was kind of just grab anything that's been down on it. The correlation is about 85% inverse versus gold and the dollar right now. So you see a correction. Say we get this miss on the jobs report tomorrow, you're going to see the dollar index come off. You're going to see gold a thrust into short covering. Gold should break through that 50-day and punch to the upside. Probably go up on the top end of the range, I'd say 1750, where it would be overbought again. But I just don't see it where gold can have a sustainable rally at this point. That's why for counter trend trading, like gold and silver, they've been in downward trends. I think that rather than being a hero and trying to buy the bottom or catch the falling knife, you look at something simple like a call spread, like something that we outlined in our option insights piece that we put out yesterday. We were recommending buying for seasonal strength or the possibility of a short covering rally, something like a January silver 21-22 call spread costing about $1,250.
All right, well, moving on to silver now, the gold's poorer sister, if some people might want to call it that, but it has a very different macro picture. Tell us about silver demand and your outlook for the silver price.
What people, fail to realize when they're speculating in silver, most people have a long-only approach. They think that prices are being, held down significantly for whatever reason. You have to remember that silver plays three different cards, right? Whether it's jewelry demand, and I could tell you with savings rates going down so low, people are not going out buying new jewelry. Is it this coin right here that you're speculating on? Those prices have probably peaked with most of these other asset classes, like things like baseball cards, collectibles, and other things. Those are all coming down. I think really the price of silver hinges and the demand hinges on, a boost in the economy and an underlying boost in things like iPhones, which contain about 36 cents of silver in each iPhone. So unless you see this robust growth in technology demand and things like that, or an expansion in these power grids and everything else, silver prices are going to remain at a lower level.
Yeah, and I'm guessing based on what we discussed earlier, you don't see this robust growth in the tech sector anytime soon.
Not at the moment here. I think that really once we get out and the Fed starts to cut and they make that pivot going into next year, they're expecting one rate cut in 2023, two rate cuts in 2024. That's when you're going to get that first sense of true organic growth again, I think, in the markets. And that's where you get that push up. Now, I'm not saying that you're not going to get these volatility events where silver goes up $2 or $3 in a day, like what we saw earlier in the week. I'm just saying sustained organic growth to the upside needs to come back in when the consumer's back in buying these electronics that make up the bulk of silver demand.
Let's move on to oil. I like to talk about energy. A lot is happening in the energy markets geopolitically as well. As you know, there's a energy crisis going on in Europe. A lot of Europeans I talked to said that their friends are concerned about energy prices, to say the least. Some people are drastically cutting back their spending. Some people straight up can't afford energy bills, and the governments have to step in and subsidize. It's a mess over there. But let's just back up and talk about oil, crude oil, and then we can talk about natural gas in Europe. What's happening with crude oil? It's been dropping like a stone over the last 6 months.
Well, since then, we now have a boost off the low end of the range. So you look at crude oil now, $88, $89. I mean, I think we're going to be over 90 probably if we start to see some of this inflationary tail where if you get the dollar index selling off tomorrow on the jobs report, you're going to see oil punch through $91, $92. I think that OPEC is, they are coming out and, they claim not to be committed to price targets and things like that. But I believe that, this $90 to $100 range is coming back into the cards on oil. You can't cut 2 million barrels per day and not expect to see upward prices. If you look at inventories, U.S. inventories have been declining. The EIA data has shown a series of drawdowns, and these are both bullish headwinds for that market. That market is a market that everyone remembers is one to go to when things start to turn up. And all you need is oil breaking through 90. It's going to get all over the headlines again. The Biden administration is going to have to release from the EIA, which is dangerous because you're taking us into a vulnerable spot by dwindling those supplies down. And I think that people and investors and speculators will come back into the energies.
The natural gas price in Europe has spiked several times over the last couple of months, while crude oil, despite the recent bounce in the lows that we've seen, the long-term multi-month trend has been down. So I'm just thinking, Phil, the natural gas price surge that we've seen in Europe, that's specific to just the Russia-Ukraine issue, right? It's not a macro, bigger picture that's pushing up energy demand, pushing up energy prices. None of that's going on, right?
If you see a unseasonably colder winter this year, any kind of supply disruptions in the U.S., we believe natural gas prices could achieve $8, $9, $10 again easily. They're down in the high sixes, low sevens at the moment. Again, on our options insight piece, we put out a recommendation going out for February natural gas, buying a $7.50 call spread. So we are bullish on natural gas. Prices have declined. We think that using an option strategy like that's the way to play, getting you out through the winter.
Okay. All right. Finally, what is your favorite commodity play right now? Is it energy? Is it something else?
It's got to be the energy markets. I mean, I don't see things like there's nothing that stands out in the softs whatsoever space. There's nothing in the agricultural markets. The wheat chart looked pretty good, but you look at those, they're starting to decline. The dollar poses a major headwind. I think that copper prices are going to move lower. I just don't see, there's not a specific like commodity out there, like maybe something like palladium, platinum, if they're going with the microchips, that could be the play, but I just don't see it. Even everything from like cattle, you tend to get that strength on lean hogs when you go into a recessionary environment. People buy the cheaper meat. So that could be something to look at, but there's nothing out there that's like very specific that is like a silver bullet for a commodity going up. I think energy is probably your best play.
All right, Phil, champion trader, congratulations on your success recently, and I look forward to speaking with you again soon. Thank you for coming on the show today.
Thanks for having me. Take care.
And thank you for watching Kitco News. I'm David Lin.